firm that's going to be acquiring this company. And you're the analysts, okay? You're the financial analysts, or the acquisition analysts, or the acquisition associates, or the junior underwriters, or the underwriters. I mean, there's a bunch of different names for you, but that's who you are. The next one, we're going to do business investment banking, larger, more established tech companies. And for each one of these, they're nuanced. It's not like your homework problems or your problems, which are just problems that you're doing. These are actual case studies. Okay. What we're not going to do is we're not going to build the Excel spreadsheets around these because that would just take too much time. But just know that underneath this, there's a lot of Excel spreadsheets that are doing all the cash flow modeling, and then you're running the discounted cash flows, present values, internal rates of return, break even, which are basically the investment decision-making matrix that you're going to use to make the investment decision. Are we rolling?
Yeah.
Awesome. And then on page 3, we're going to do a stock valuation of an established tech company, okay, like IBM or Intel. And then on page 4, we're going to value a real estate investment trust, which is also called a REIT security. So this is a real estate company that owns and manages institutional grade property in core markets across the United States, and they basically run and build and manage, millions of square feet of property, and then they pay out, the majority of their earnings back to their shareholders as dividends. Okay, so we'll do that too. And then we're going to do a commercial real estate development. We'll walk you through that. That's a $1.5 billion transaction. Oh, that's downtown. That's Salesforce Tower. It's on page 5. That's Salesforce Tower. And then on page 6, we're going to do a biotech, biomedical, university research campus that looks and smells just like Mission Bay, developed by Alexandria, which is one of the top biomedical, biotech, research institution, real estate investment trust. Okay, they build and manage, their projects are in the billions each. And then on page 7, we're going to go through and you're going to memorize the investment decision-making matrix. Okay, and the 4 iterations that we all have to go through to make investment decisions. Okay? And then I have these extra credit. These were used for accreditation. I just throw those on there if you guys want to take a stab at it. But it's not required. All right, so let's get started. Any questions before we get started? Admin, come see me. I'm around all day Wednesday because I canceled all the classes to basically railroad you in to go into my event. Corralled you into it. But thank you very much for that. So I'll be in my office all day from 7 in the morning until probably 3 in the afternoon, until I have to go make sure that everything's set up correctly. Because if it's not, I'm going to have to rearrange a lot of stuff to get it to work the way it's supposed to work. Okay, I got 120 professionals and I got 88 students coming, so I might even get to my almost 300 that I'm shooting for. Okay, I don't know, do they have 300 people or 200 people that's there? By a club. Okay, so let's do that. So the first one is venture capital. Venture capital, they're called VCs or venture capitalists. They all hang out down on Page Mill Road and Sand Hill Road, down in Palo Alto, Atherton. A lot of them did engineering degrees. They went to Stanford and stuff like that. They're all smarty pants people. They work in the venture capital world. They basically raise capital from their investors. They invest in these companies. They incubate them as a portfolio of companies. And then when the time is right, they'll spin off the companies to a private equity firm, or they'll take the company public through an initial public offering and make billions of dollars. Okay? So that's what we're trying to do here. So the first one is, as we know, there are 4 main valuation methods. In this case, we're going to use earnings before interest, taxes, depreciation, and amortization, or better known as EBITDA or free cash flow. When you're doing with these smaller companies, you can't use earnings because the company's not established. You got to use free cash flow or EBITDA, which is basically a top line revenue number to get to the multiples, to get to the valuation. Okay. The following are the case study assumptions, the models used. We're going to use perpetuity, not only for an initial valuation, but also we could use it for the terminal value calculation, which really didn't go over in much detail what we are in this case. We can use the Gordon growth or the constant growth model for both the initial valuation, but also for the terminal value. We can do that calculation using Gordon growth. We're also going to use the multiple approach, and they actually give you the multiples right here of recent transactions that have occurred. So we don't have to calculate the multiples ourselves, but I'll show you how the multiples are actually calculated at the enterprise value. It's in the book, but it's a little further back in the book. I just can't. This stuff's so great, I got to get to it like right now because I'm so excited. Okay, and then the last model is the discounted cash flow model, or the DCF. Okay, where we're going to basically project out and grow the cash flows, come up with the terminal value, add that to last year's cash flow in the holding period, discounted back by the discount factors to get the present value. Okay, and then we're going to do some capital budgeting and figure out if this is a good transaction, would we accept it, or reject it. Or even if we wanted it and we still get, we get a negative net present value and we still want it, we got to go through like 3 more iterations before we say, okay, it doesn't work, but it may work, and if it doesn't work, then maybe you guys have to go back and redo the research and the underwriting, run them through the valuation model again and see if maybe you made any mistakes or if there have been any new information that had come out since over the last 6 weeks that you've been underwriting this this billion-dollar company. Are you going to be working in billions and millions? Yeah, you're going to be working in billions and millions. Okay, so I would just get ready for that. All right. So the assumptions are this is a small tech startup in the software consumer product space being bought by a private equity or a venture capital firm. Can these small tech startup software companies, can they scale pretty rapidly? Yeah. Social media marketing campaigns, boom, before you know it, you got, 10,000 customers, you got 100,000, you got a million, 10 million, 100 million, and maybe if you're Facebook or some of those other guys, you got a billion or 2, under wraps. Okay. Also show the calculations for the valuations utilizing the above methods. So we get the free cash flow for this year, we got the free cash flow growth rate, constant growth rates that we're going to use for Gordon growth. You might want to take some notes down. The expected return, which is what we're going to use as the discount rate here, is 30%. Does that sound high? Our investors are requiring a 30% rate of return on their investments. Does that sound high? Yeah. But do you think there's a lot of risk? Yeah. So they want to be compensated for the risk. And then we got the holding period. The holding period is going to be 3 years. Why do we have the 4th growth rate? Test question. Why do we have to grow it out 1 more year to calculate the? I'm just asking questions. Either if you don't know, just say I don't know, and I'll tell you the answer. So why do we use 4 years instead of 3 years? What do we use the 4th year cash flow for? I think there was one problem on the exam. Don't know? To calculate the terminal value. Okay. So you always have to grow it out 1 more year, and I'll walk you through the whole procedure. And then the target company acquisition price is $200 million, and it's a 3-year holding period. And what we're going to do is we're going to use the different approaches. We're going to come up with the intrinsic value. We're going to use DCF to get the present value, net present value, internal rate of return. We may use break even. I don't think so. Then the question is, do we accept or reject the project? And if we do reject the project off, right off the bat, the board of directors or investment committee or the senior level managers may actually still want to go forward with the deal, and we got to go through 3 more iterations to make sure that we're making the right decision, because we don't want to be rejecting projects or companies that we should have acquired, right? Or acquiring properties that we should have rejected. Right? Those are pretty big mistakes when you're looking at a couple of $100 million. Okay, so let's go through the valuation. So what's the first intrinsic valuation number? Perpetuity, got it, excellent. So one. All right. So when we're calculating the valuation using perpetuity, what's the equation?
Cash flows next year.
Yeah, excellent. So the
Over.
cash flow next year, got it. Divided by,
Discount rate.
got it, awesome. It's gonna give us the valuation using the perpetuity. Got it, okay, excellent. So how do we calculate next year's cash flow, and what cash flow metric are we using? What are we using as the cash flow? It's on your sheet. All the answers are right there. So what are we using for the cash flow to get the valuation?
EBITDA.
We're using the EBITDA. Got it. Excellent. The CFO is equal to, and what's EBITDA?
20 million.
Yeah, but what is it? What does EBITDA mean? Excellent. Got it. Okay. And then how do we get next year's cash flow? This is kind of like an oral, see you guys. So how would you get next year's cash flow? What do we have to do? What are we using? Do I use last year's, this year's, next year's cash flow to get next year's cash flow? How do I get next year's cash flow? Do I use last year's cash flow to get next year's cash flow, or do I use this year's cash flow to get next year's cash flow? Do I use next year's cash flow to get next year's cash flow? Do we have to calculate it? Which one?
This year's.
Yeah, so we use this year. So what's the cash flow for this year? T equals 0. What is it?
20 million.
You got it. So EBITDA T equals 0 equals 20 million. Got it. So how do I get next year's? Do I divide it by something? Do I multiply it by something? Do I take it out for dinner? What do I got to do with it? How do I get next year's cash flow from this year's cash flow? Look here. All the answers are here. If you read this, it might give you an idea. Does it give you any growth rates? Yeah, what does it give you? Go ahead, just yell it out. No wrong answers. What growth rate are we going to use? Come on, yell something out.
15%?
What is it?
15%?
That's going to be the going in, which we're going to use for the Gordon growth model. Nice try.
Is it 40%?
40%, because isn't that the growth rate in the first year? Yeah. So we're going to do 40, 28, 25, and 15. Why is it higher in the first year compared to the other years? This is all the nuanced stuff you're not going to learn from the plot. Okay. So why is it higher for the first year than all the other subsequent years?
Startup.
It's a startup, right? And we're going to buy the company, we're going to reposition it, we're going to restructure it, we're going to optimize its supply chains and its advertising and all that stuff, and we're going to grow the company pretty quickly within the first couple of years. Got it. So what do I do with the 20 million? How do I get first year cash flow using the year 0? What do I have to do to it?
Multiplied by the first year cash flow growth.
Yeah. So what's the equation? And test it to see if you're going to grow something out.
20 million times 1.4.
Got it. 1.4. Excellent. And what does that give you? What will happen is at some point, it's all gonna like click in your head and you guys are gonna be firing questions at me at some point pretty quickly.
28.
What is it?
28.
28, got it. Now, is the 28 million last year, this year, or next year's cash flow? next year's cash flows, isn't that what we wanna use? Yeah, awesome. And then, this is pretty straightforward, right? You divide that by the, by what? What do we divide that by to get the valuation? Or do I multiply it by something? I'm just trying to confuse you. I'm sure I'm doing a good job. So what do I do with the 28 million? I divide it or multiply it by something to get the value used in the perpetuity model? Divide it. And then what do I divide it by?
40%?
Yeah. And what's the discount rate?
30?
30. So I'm gonna divide it by what? I'm trying to get into the, I'm not convinced some people are totally comfortable with that. So you would divide it by what?
Isn't it 40?
No, it says the terminal discount rate is 40. We're gonna use that in the DCF model.
So you're using expected rate of return?
Yeah, we are.
So
Okay.
30.
30. And then, so I divide 28 by what?
Okay.
Got it. Just checking. Just checking. I know it might be really simple, but I'm just making sure that I'm not losing everybody. Okay, so what's 28 million divided by 0.3? Everybody's got to get their calculator out and start listening to the pitter patter of your clicking hands on those calculators.
93.33.
What is it?
93.33.
We'll just round it. So when somebody yells out an answer, do you just take it face value when you have 30 people in the room?
No, you check it.
You check it again. So is that correct?
Yeah.
Yep. Okay, one more person. I usually like to have 3.
Yes.
Okay, perfect. Thank you. Okay, so we got the first one. What's the second intrinsic valuation method?
Going to the bottom.
Yeah, or constant growth. Actually, I think I can go back over there. Is Gordon growth similar to the perpetuity model?
Yes.
Yeah. Is it a simplistic model?
Yeah.
Yeah. Got it. And then what do we need to, what's the equation for the Gordon growth model?
Cash flow.
Yeah, cash flow next year.
Divided by how?
Got it. I minus G is gonna give us the BGG. Got it. And then do we know what next year's cash flow is?
Yes.
Yeah, what is it?
28 million.
Got it. So that's 28 million. And what's our discount rate? 0.3. And what's our growth rate constant? What is it? Do they give us a future growth rate going in?
15%.
Yeah, it's 15. So 0.15. That turns to 0.15. Got it. And what is 28 million divided by 0.15? You can almost just double this, right? What is it? You gotta have your calculators out. Everybody's gotta have their calculators on their desks, cranking out these numbers, practicing how to do the calculations. This is how it's gonna be, this is how it's gonna work. You're gonna be in a meeting. This is how exactly it's gonna work.
100.
You're gonna be in a meeting, okay? And the managing director is gonna be up here, basically schematicking things, and is gonna need you to be able to do the calculations. There's gonna be 2 types of individuals in the room. One is gonna have their calculator out, cranking out the numbers, and giving the person the number as quickly as possible. Then there's gonna be another group of people that are gonna be just sitting there, okay? Waiting to get the number. Now, I'm gonna want people in my meetings that are cranking stuff out, okay? Checking the numbers, making sure they're correct, you know, on their computers, maybe on their laptops, but just cranking the numbers out with their calculators, making sure we're not making any mistakes, because these are some big numbers, right? Yeah. So what did you say? I'm sorry.
186.67 million.
186.7?
67.
Yeah, just round it.
Okay.
Okay, so 186, almost 187 million. Got it. So that's that one. Once you're gonna get these down, it'll move a lot quicker. The only thing that's different, that'll change is the methodology evaluation is not gonna change, the philosophy, but it's gonna be the asset class. It's gonna be the asset. Is it a stock? Is it a company? Is it a tech companies and established companies, real estate companies, real estate asset, what is it that we're valuing? And you change the nuance depending on the asset that you're trying to underwrite. So what's the third one?
The multiple approach.
Yeah, multiple approach. And I'll just tell you right now, it's the multiple approach. Multiple approach and the DCF that are the two basically main methodologies. That perpetuity and Gordon growth are pretty simple. And we can actually convert these into multiples. So the investment bankers, private equity bankers, the finance people are always thinking in multiple, cash flow multiple terms. Okay. So what's the multiple equation?
Cash flow T plus 1 times multiple T plus 1 equals the value of the multiple approach.
Exactly. And all of these actually, all of these valuations are T plus 1. Because we're forecasting out the cash flow, so everything's, is forward looking. We use history, we'll use the current numbers and we'll use historical numbers as just a guide, but we're always looking to try to project what the future is. And do you think it would be pretty valuable to be able to project out what the stock price would be in the future, or what the value of the firm will be in the future? Yeah, I get asked to do that stuff all the time. All right. So do we know what the cash flow is?
Yes,
Yeah, what is it?
28 million.
Got it. 28 million. And then I'm just gonna do the equation here, because they do give you the multiples, but I want you to know what the multiples look like. So here it is going to be the sales price for the company. Divided by the EBITDA. So this is called the EBITDA multiple, okay? And there was 3 transactions that occurred over the last year of companies similar to the one we're looking to buy. So we've got those transactions, we've got those comparables, we've got those comps, which is what they're also called. So we have these. And what are the multiples of the most recent transactions of firms similar to the one that we're looking to acquire? That's the target firm, we're the acquire-or. Target firm, acquire-or. Okay. And there's a whole chapter on new venture finance here, in the Carino book, but it's okay. So what are the multiples that they give us? Do they give us any multiples? Hello? Anybody home?
22, 44, 55.
Yeah, exactly. So 55 times, what was the other one? 44 times, and the other was 22 times. Got it. And so there has been some other transactions that occurred in the marketplace over the last year where the companies buying the target companies were willing to pay 55, 45, and 22 times their cash flows. Okay. So what's 55 times 28? 1,540, right?
That would be 1,540,000,000.
Wait, hold on, what is it?
1,540,000,000.
500.4 billion. I'm gonna go straight to the billions,
Okay.
okay? And what's 44 times 28?
1.232 billion.
Okay, and then what's 22 times 28?
616
So
million.
0.6 billion? 600 and something million?
660 million.
660?
16.
616?
616.
Got it. Okay. So the question then becomes, where are we in the business cycle right now? In the capital market cycle? What's been happening over the last 10 years? Are we coming out of a recession? Yes or no? Pretty obvious. Are we coming out of a recession? Are we coming out of a recession? When was the last recession? 2008, 2009, what's today? 2019, so are we coming out of a recession? Are we, after 10 years? No, I don't think so. Okay, so are we late stage? Business cycle? Yeah, okay. When do cash flow growth rates grow faster coming out of a recession or late in the cycle? When do you see the fastest growth rate in cash flows? Coming out of the recession, got it, okay. So what's the probability that somebody's gonna pay 55 times the cash flow for this company at this point in time? Lower, right? What about, are we going into a recession? No. Are we in a recession? No. Are we at the peak of the capital market cycle? Yeah. So we're probably what? Probably here. Would this be a safe multiple to use? Because we're not at the peak and we're not at the bottom, we're somewhere in between. Okay. So I'd probably use this one. Got it. Okay, we got these already calculated. Excellent. We need one more. What's the next one? Yeah, the discounted cash flow. Where'd the DC at? The first thing you want to do is you want to ask yourself, well, what's the holding period? So 3 years, 3-year holding period. Is that a short period of time? Yeah, short term. It's opportunistic. They're going to buy this company, they're going to restructure it, they're going to exploit it, they're going to grow the revenues, either they're going to take it IPO or they're going to sell it to a private equity for cash out. Maybe. What was that? What are we trying to calculate? What do we calculate? Yeah, we're trying to calculate the present value of the cash flows, present value. So it's the PV. And what's the holding period? 3 years. 1, 2, 3. Is that it? Is that
Plus
the number?
TV over a certain value.
Yeah, so we need to do what? To get the terminal value, we need to do one more. We gotta do something. I just talked about it like 10 minutes ago.
We have an extra year.
Yeah, we gotta have an extra year, so we gotta grow it out one more year. Got it. All right, so what do you wanna do? Do you wanna do the cash flows first or the discount factors?
Cash flows.
Cash flows. And then do we know what the cash flow is gonna be for the first year? 20 million. And how do I get year 2 cash flow?
T plus 2.
Huh?
Do that with like T plus 2.
Yeah, what is it?
28%.
28%, so what's the future value factor that I use to grow out the cash flow, to get the second year cash flow? What are we gonna use? You gotta look down here because this is where it's gonna be on exam day. So what do we use? What are we gonna use to determine the future value factor that we're gonna use to grow the first year cash flow out to get the second year cash flow?
Year 1 times 1 plus T plus 2.
Okay, you had it the first time, you're really close. So what do I use? What exactly do I use? What growth rate did you use for the first year?
T1. T plus 1.
Yeah, but what was it?
40%.
Got it, so what do you use for the second year?
28%.
And what's the future value factor? 1.28.
1.28.
Got it. Okay, and what's 28% 28 million times 1.28.
35.84.
35.8. Okay, is that correct? I only heard one person.
Yeah, 3,500.
Okay, got it.
Yeah.
Thank you. And then how do I get year 3?
Multiply that by 1.25.
Got it. Okay, and what's 35.8 times 1.25?
44.8,
What is it?
44.8.
Thank you. All right, are we done?
No,
No. We need to calculate the 4th year cash flow. What do we use the 4th year cash flow for? Say it?
Terminal value.
Yep, calculate the terminal value. Excellent. So how do I get the 4th year? How do I,
And she's multiplied by 1.15.
yeah, I'm just going through like really nitpicky, okay? Because I know I kind of threw this stuff at you on the first exam, now I'm like really drilling in on the mechanics, okay? So 1.15, so what's 44.8 million times 1.15?
51.52.
What is it?
51.52.
51.52, got it. Excellent. All right. So how do we calculate the discount factors? Do we know what the discount rate is, or the expected return?
30%.
Yeah, 30%. So what would be this equation right here?
1 plus 0.3, then
And what's that?
1,
Got it. And what's 1.3 to the 1?
1.3.
Got it. And what's this one?
1.3 to the second.
Got it. 1.3 squared. So what's 1.3 squared?
16.9.
What is it?
Oh, never mind.
1.66.
What is it?
1.69.
Okay. And then what's this one?
1.3 to the third.
1.3 cubed. And what's 1.3 cubed?
So
2.197.
What is it?
2.19.
2.197. 2.1917, right? 197. 2.2. Got it. Okay. What about this one? A little harder.
1.3 to the fourth.
1.3 to the third.
No. This one's different. Because we're using the cash flows to calculate the terminal value. Okay. Now, let's talk about this for a second. What kind of company is this? Startup company. Do you think the cash flows are going to grow at a constant rate for a long time? No?
Yes.
Maybe IBM. This is a startup company, right? Consumer product software. These things go, become, you know, these, what do they call them, unicorns, you know, that sell for billions of dollars. So do you think that the cash flows are going to grow at a rapid rate?
Yeah.
Yep. Okay. So if we were to assume that they were going to grow, these cash flows were going to grow at a constant rate for a long time, what model would I use? I'd use Gordon Growth. And does it give you here any, since we're calculating, using this to calculate the terminal value, do they give you any terminal discount rates or going in?
40%.
Yeah, 40%, so 0.4. And then what's the growth rate assumption? Terminal growth rate. 10. And this gives you what? 3. What's 51,500,000 divided by 0.3? What does that give you?
171.67.
What is it?
171.67 million.
6, 7?
6,
Yeah.
7.
7?
6, 7.
Yeah, I'm rounding.
Ah, my bad.
That's okay. You're cool. Okay. So did we calculate the terminal value? Yep. What do we do with the terminal value?
Plug it in.
We have to do something.
We add it.
You add it to, yep, the last year in the holding period.
I get 0.4 and 0.1.
this was right here, I gave you the, under expected rate of return, I gave you a terminal discount rate, or an expected return of 40%. And then I gave you a terminal growth rate of 10%. So here's a nuanced question. Okay. What's the going in expected return? What is it? 30%. And what am I using for the terminal? 40%. So why am I adding, 1,000 basis points, onto it? Why am I tacking on another, 10 percentage points?
Because it's the next year? It's the future year?
Say it.
It's the future year?
Yeah, it's the future, right? It's basically this terminal value captures all of the value in the future from year 4 on, okay? Now, is the future easy to predict? And if you can't predict the future, what's that called? If you're in business or investing. If I can't predict the future, what's that called? Risk. Risk, right? Isn't it risky if I don't know the future? I know here with relative certainty, I don't know the future here. Is that risk? And would you want to be compensated for higher risk? Don't you do that by using a higher expected return to reflect that risk? And what kind of company is this? It's a startup company. Startup companies in the consumer product software space, is that a highly competitive space? Yeah, so you want to be compensated for that additional risk. And what about the constant growth rate? What was the going in constant growth rate that we used in the Gordon Grove? 15%. And what's the terminal? 10%. Do you think that maybe that 10% is the slowing of the cash flow growth rates is a reflection of increased competition at some point in time in the future? Yeah. So I take down the constant growth rate and I take up the discount rate to reflect the risk that I can't predict from year 4 going forward, reflected in the discount, in the terminal value. Okay? Because if I use in the book, the way the book does it is they'll use the same going in discount rate, expected return for the terminal, and they'll use the same going in growth rate for the terminal. What does that assume? If you're using a lower discount rate and a higher growth rate, what happens to the terminal value? Is it higher or lower? If this goes down, the terminal value goes what? If that goes down, the terminal value goes up. Okay? If this goes down, the terminal value goes. This goes down, the terminal value goes down. If this goes up, the terminal value goes down. Let me do it again. If this goes down, the terminal value goes okay. If this goes down, the terminal value goes up. If this goes up, the terminal value goes.
Wait, which variable are you pointing at? That's confusing.
Okay.
If this goes down, the terminal value goes down. If this goes up, the terminal value goes down. If this goes up, the terminal value goes up. If this goes down, the terminal value goes down. Okay. So, if I'm using a lower discount rate, what happens to the terminal value? It's going to be what? Higher. If I'm using a higher growth rate as the terminal growth rate, what's going to happen to the terminal value? It's going to be higher. So I could be overestimating the valuation of the company in the future. And that's how you little analysts do these things, okay? Because when we're sitting around with a bunch of board members and investment committee members, you're jerry-rigging the valuation by basically using higher growth rates and lower discount rates for the terminal value calculation. So you're juicing the present value through financial engineering. There's going to be a few people in that room that's going to call you on it, because they may actually find out that you were jerry-rigging the numbers, because why would you be jerry-rigging the numbers?
Make your company look better?
What?
Make your company look better?
Well, not if it's wrong. But what about you? Because the acquisition's, associate. Do you think you're going to get bonuses by doing this transaction? Yeah. Salary? Yeah, and then like 3-4 years from now, when they find out that you engineered the terminal value to be inflated and the actual company wasn't worth as much as you said it was, some people say, hey, screw it, I don't care, I already got mine, you know, in Sausalito. You know, just go find another job at that point. Do you think that stuff happens? Yeah, all the time. But ethics and morality does take hold, and you try to present, you know, the best underwriting that you can on behalf of the stakeholders, the stockholders of the company, that you make good, really good investment decisions so that all of the deals that you underwrite are successful. Okay? That's really where you want to go. Okay? Because then you'll have a track record. Okay? One person that has maybe one or two good ones and some bad ones, you know, you want to have a good track record, you know, in your underwriting. Okay, got it. Now what do we do? What? Now what do we do?
Would you accept or reject?
So don't we have to add these together?
Yeah.
Yeah. So can you do that for me? Is this the cash flow we're gonna receive in the last year of the holding period? Yeah. So we need to add those together. What do we get? $216.5 million.
Can confirm.
Is that right?
Yeah, I confirm it.
Okay, awesome. Now what do we do? Now what's the next step or steps?
We do the breakdown,
Yeah, what are we gonna do?
you do like divide all the numbers and then.
So you're gonna calculate the discounted cash flows. Okay? So why don't we do the first one first? So what do we do, divide 28 million by?
1.3.
1.3. Got it. And what does that give us? You're probably already ahead of us.
Here.
You probably have them already calculated by now.
That's 21.54.
21.54, I'll give it to you. Okay? And then what do we do now?
We then divide the next value.
Can you explain how you got the 216.5 million?
I grew the 30-year cash flow out
Okay,
by 15%, I got 51.5.
okay.
Okay. Then I took that and I divided it by the terminal expected return or discount rate minus the terminal growth rate, gave me 0.3. I divided it into the 51.5, and I got the terminal value of 171.7.
Okay.
Then I took the 171.7 and added it to the cash flow in the last year of the holding period to get 216.5.
Got it.
That's what we're gonna use to discount. Okay, so what's 35.8 divided by 1.69?
21.18.
21.2.
18.
Got it. Now what do we do?
Divide that large value by 2.2.
Got it. And what's 216.5 divided by 2.2?
98.41.
98 point what?
4.
Got it. So you said, do we have all the cash flows? And did we calculate all the discounted cash flows? Yes? No? Do we calculate all the discounted cash flows?
Yes.
Yes. So now what do we do?
Sum.
Add them up to get the present value. Got it. And what is it? 141.12. Got it. Okay. All right. So let's take a look at this. So I got 141.12. I got 1.23 billion. I got 186.7 million, and I got 93.3 million.
I got 141.14.
1.4? Okay, awesome. Okay, so does it, I mean, do the analysis, do the valuation analysis. Does this look right? What does this tell you?
Something's
Now, you, what?
It's something screwed up.
Or, I mean, where's the issue?
I would say that there's such a big difference between 3 and 4.
Yeah, there's a huge difference between the multiple approach and the other three methods. Okay. The question is why? Did we overvalue or undervalue using the other methods?
Way over.
The other, 1, 2, and 4, did we over and undervalue? The undervalue, okay. So if we undervalued it, let's say we did, where did we make our mistakes? What was the flaw in our assumptions? Well, one, perpetuity assumes what? About the cash flows.
Stays constant.
Well, they're what?
Constant.
Yeah, they're flat, right? They don't grow at a constant rate, but they remain flat. Is that realistic? No, so you throw that out. And then what about Gordon growth? Yeah, so what about the constant growth rate? If we're getting 1.23 over here, what's the problem with that?
It's not high enough.
It's not high enough, okay? The market assumes that the company's gonna grow its cash flows significantly higher using the multiple approach, okay? So obviously the Gordon growth model is flawed, the constant growth rate's too low, okay? If you assume that the multiple approach is the most correct approach. And then for the DCF, you can see it's 141 million for the present value. Where's the problem?
Undervalued the future. But
Yeah, it's undervaluing it based on what? Where's the problem?
year 4. The term.
Terminal value.
Well, there's that, right? Let's say we don't deal with the discount rates. Where's the undervaluation coming from?
The cash flow.
Yeah, the cash flow growth rates are too low, right? And then what about these cash flow growth rates? Could these be too low too? Yeah, exactly. Okay. So if you crank these up, and you get to 1.23, it's gonna tell you what the growth rate assumption is gonna be. And you can do it with Gordon growth too. So by knowing what people are willing to pay for it, you can back into some of these numbers and see if it's realistic. Yes.
How would you know like the numbers for like 1, 2, and 4 are pretty similar, and 3 is like way different? That like 3 is more reliable. Than
Yeah, well, why is that one the most reliable?
I'm not sure.
What?
I'm not.
Well, did they give us the multiples? Yeah, were they based on research? Of actual transactions that occurred over the last year? So this is what people are willing to pay. Not based on some finance theory. Yeah, we got finance theory, but this is the actual deals. There's 3 deals that went down, 3 real deals that went down. And even the one that went down at 44 times still gives you 1.23 billion. So companies are willing to pay 1.23 billion for these types of companies. And what's the company being sold for? Would you buy it?
Yeah.
Heck yeah, you'd buy it. I mean, you're coming up with a $1.23 billion valuation, and you can pick this thing up for 200 million. Heck yeah, you're gonna buy it. Of course. So let's run the present value. Let's run the net present value on this thing. We already know the present value. So let's say that the present value is 1.23 billion. Or we'll just make it easier. 1,230 million. And then what was the acquisition cost?
200 million.
100 million. If I subtract out 200 million, which is the cost of the acquisition,
That's 1,000.
from the intrinsic value, I get what?
1,030 million, or 1.03 billion.
So my net present value is my net present value positive, 0, or negative?
Positive.
Is it positive a lot?
Yeah.
Positive a lot. So if you think the company's worth 1.23 billion, would you pay 200 million for it?
Oh, that's true.
Absolutely. So in this scenario, you would accept it. You would accept the acquisition. Because the rates of return are off the charts here. So where's the problem here? I mean, there's a problem here. What's the problem?
This
It's
is
not our problem. Yeah, the company's asking too low. We don't know how much it's really worth. We may have access to better information than they do. And we can get a more accurate valuation. Because they've been up every night for the last 2 years building this product.
What does that say? Under PV?
Yeah, the acquisition cost. The acquisition cost. Could be development cost for buying real estate, could be acquisition cost, you know, could be sales price, could be a lot of things. Okay.
If it was, 0 or close to 0, we'd still assume.
Yeah, let's do that right now. Let's do that. So let's change the economics. And let's do, let's make it nice and easy. Okay, let's do that one. So we came up with a present value of 1.25 billion, but the acquisition cost is 1.5 billion. So what's the net present value?
Negative up to 250 million.
So it's gonna be negative 250 million. Now, are you gonna accept or reject it?
Reject.
You're gonna reject it. Got it. Okay. What if we really want this company? How much time do I have?
30.
How much?
30.
Okay. This is actually the answer to the, I think it's page 7. And I'm gonna give it to you up front. Yeah, page 7. We usually have like a little comment section over here. You want to take notes? All right. So, this is the capital budgeting, this is the investment decision-making. Matrix. So this is the matrix that allows you to be able to make investment decisions. All right, so we got the present value is greater than the sales price. Got it. Present value is equal to the sales price. The present value is less than the sales price. Got it. We got the net present value is positive. Net present value is 0. Net present value is negative. We've got the internal rate of return is greater than the weighted average cost of capital from your pretest. Internal rate of return is equal to the weighted average cost of capital. The internal rate of return is less than the weighted average cost of capital. Then your break even even is break even less than 3 years. Break even equal to 3 years, and break even greater than 3 years. Got it. Okay, now we're gonna do Larry's finance sing-along. Okay, very similar to the Sound of Music at the Castro, really super fun. Julie Andrews, you know, we all get all dressed up and we go down, we go sing the Sound of Music. But this is like Larry's little finance sing-along, okay? And I'm gonna go through these and then all of you are gonna sing along, okay? So, you ready? Okay, so when the present value is greater than the acquisition price, do you accept or reject? Accept. No, that's not gonna cut it. Okay, let's try that again. So when the present value is greater than the price or the cost, do you accept or reject?
Accept.
Nice. Okay, excellent. And when the present value is equal to the price or the cost, do you accept or reject? No, that's not how you do it. We're talking billions of dollars here. When the present value is equal to the acquisition price or the cost, do you accept or reject?
I don't know.
Am I going deaf here? When the present value is equal to the price of the cost, do you accept or reject? That was a little better. Okay. When the present value is less than the price or the cost, do you accept or reject?
Reject.
Got it. When the present value is positive, do you accept or reject?
Accept.
When net present value is positive, do you accept or reject?
Accept.
Got it. Okay, when the net present value is 0, do you accept or reject? Got it. Somebody's going like a balloon, you know, they're trying to do both. When the net present value is negative, do you accept or reject?
Reject.
When your internal rate of return, when your rate of return is higher than your weighted average cost of capital, do you accept or reject?
Accept.
Okay, it's weak. You guys would never last, you know, up on the hills of the Sound of Music. When the internal rate of return is equal to the WACC, would you accept or reject? Accept. When the internal rate of return is less than the weighted average cost of capital, would you accept or reject?
Reject.
Got it. I'd like to hear it louder. When the break even is less than 3 years, would you accept or reject?
Accept.
Got it. Louder. When the break even is equal to 3 years, would you accept or reject?
Accept.
When the break even is greater than 3 years, would you accept or reject?
Reject.
Got it. Now, do you see a pattern here?
Yeah.
Exactly. So here, you can know any one of these, and you'll be able to know what the other one is. So if I know that my break even is less than 3 years, then I know that the internal rate of return is greater than the WACC, my net present value is positive, and my present value is greater than the price. So if you know one, you know the other. Okay? And when you're sitting in these meetings, this is going through their heads. Okay? They can go back and forth at any one time, but they know that that's the decision. So if you know that the net present value is positive, you know the present value is greater than the price, IRR is greater than the WACC, the break even is less than 3 years. Okay. On the other side, if I know that my break even is equal to 3 years, then I know that the IRR is equal to the WACC, I know the net present value is 0, and I know the PV is equal to the price. So if I know one, I know the other 3. Okay. And then the last one is if I know the present value is less than the price, I know the net present value is negative, the IRR is less than the WACC, and my break even is more than 3 years. Okay. So how much time do I have?
1 minute.
Okay. So in this case, what happened?
You got a negative net present value.
Yes, we ended up rejecting, right? But But the board of directors, the investment committee said, you know, we really like this company, we think you guys did a pretty good job in underwriting, but we really think that that this company is probably something we'd want to own. So what would be the second iteration? What's the first thing that we could do? Going back to the seller, what could we do by going back to the seller? What would we do? Not re-underwriting anything, but I want to get this deal to work. So what would I do?
Negotiate.
You negotiate the price reduction by how much?
At least
The negative value of
You got it. So I go back and get a price reduction in the amount of the negative 250. And if I got a price reduction in the amount of the negative 250 or more, what would be my net present value?
either zero or positive.
0 or positive, and would I accept or reject?
Exactly.
Got it. So basically what we do is we ask for a price reduction. In the amount of the negative NPV. Got it. So if I can go back and I can get a price reduction in the amount of the negative NPV, my net present value is either gonna be positive or 0, and I'm gonna accept it. I'm gonna get it to work. Now, the seller's nice people. What do they want? What do the sellers want? What do the sellers want?
To take
most they
profit.
can get.
Yeah, they want the most they can get, right? So can you always get a price reduction in the amount of the negative NPV? So then what do? You go back, sorry boss, we couldn't get the price reduction, let's get the board back together again, the investment committee, let's talk about it, we really want this company. Now what do? We go to iteration 3. Okay? We just don't throw in the towel. The book just talks about, you know, accept, reject. It's not the way the real world works, it's iterative as opposed to binary in the decisions. So the third iteration, if you were the analysts and you could not get the price reduction that you needed to make it work, what would you do? If you were the analysts, what would you do? What? No, what would you do?
I said like just do more research.
Yeah, you do more research and you do what? You go back and re-underwrite all this stuff, wouldn't you? So once you start yelling out the assumptions that you would go back and review to see if you either made a mistake or maybe there's better information now that you can plug into your model that'll get it to work. So what are the assumptions? So what were the assumptions in the model? It's all on the page. It's right there in front of you. What assumptions would you go review?
Just want the-
What?
Do you want the list?
Yeah, give you the list. This is a learning process to grind it into you.
Would it be the multiple?
I would probably go see if I can find some other multiples. I would agree about, because some other transactions could have occurred over the last 6 weeks when we were doing the underwriting, or somebody did a private transaction that we didn't hear about, but we knew. I went to college with the person, you know, and they gave me the number. Okay. What else?
Check out the growth rates.
Yeah, the growth rates. And what are the growth rates? How many are there? What growth rates? How many growth rates are there on that page? And just yell them out. Give me the growth rates. Which ones are they?
Isn't it 15% in the terminal?
Yep.
Is that what you're asking for?
Yeah, but I'm not looking for the actual numbers, I'm just looking for the assumptions. So what kind of growth rates are there?
Future cash flow.
Future cash flow growth rates, got it, okay. Or pro forma cash flow. What else? If I can increase the pro forma cash flow growth rates, what's gonna happen to the present value and net present value? If I revise up the growth rates and the pro forma cash flows, what's gonna happen to the present value, net present value? It's gonna go up, okay? What other cash flows do we have there? What other cash flows did we use to calculate intrinsic values?
I have a question. For the review assumptions, do you only use that for the present value, or is that for the net present value?
Everything. Because we've got rejections right here. We couldn't get the price reduction. So now we gotta go back and look at all the assumptions. Now I'm testing you to see if you know what assumptions, what variables would impact the PV, the MPV, the IRR, and the break even.
Thank you.
So what are their growth rates? Come on, analysts. I got a bunch of you in here. Should be reading your thing. Don't not looking up here. The answer's not up here. The answer's on your worksheet. So what are the growth rates? Come on, you guys, look on the page. You're burning time. I'm not gonna get through it. What?
Is it the expected rate of return?
That's the discount rate. We can talk about that in a second. I'm looking for two growth rates.
The growth rate going in.
Yeah, the going in growth rate for the Gordon growth. And what's the other one? Terminal. So test question. Were the growth rates too low or too high? Were the growth rates too low or too high? Too low, exactly, too low. And then you said what? The expected returns? If I'm getting a negative net present value, are my expected returns too high or too low? Too high or too low? Am I using too high of a discount rate or too low of a discount rate? Am I asking for too much in return or too little in return? Too much, exactly. Any other assumptions? Oh, what about the first year cash flow? Right, is that gonna have an impact? The very first year, the T equals 0. Right, the first year cash flow was 20 million. What if we underestimated by 10 million and it was actually 30 million? Is that gonna impact the present value, net present value, internal rate of return, break even? Yeah. So you gotta go through and write down all the assumptions. But I got bad news for you. You guys went back and you reviewed all the assumptions, and you put some of the new data in there, and you still got a negative net present value. Still got a negative net present value. So you got one more iteration. You got one more thing, and that's it. You can't do any more than that. Okay? And that's where you're gonna have to calculate the value of a real call option. You're gonna have to calculate the value of a real call option. Now, the book's really funny. They actually don't even, they talk about real call options like in chapter 24. And they talk about capital budgeting, you know, in like chapter, 10, 11, 12 in there. So you got all these chapters that there's no connection between the two theories. And the calculation of the real call option is one of the most revolutionary concepts in investment decisions. Okay? So the value of these real call options are driven by 3 factors, the actual value. Okay? One is management's decision making. Because the management can decide to do the project, not do the project, delay the project, undelay the project, maybe put an option on a down payment on the project and wait to see if the values increase enough for them to justify the value. So management decision making actually adds value to this real call option. The other is volatility. Volatility in the value of the company. Now, are tech companies highly volatile? Cash flows, valuations, stock prices? Yeah, because there's such intense competition and the technologies change rapidly. That can impair them. And then the last one is time value. options are long. They're 3 years. They could be 3 years in the making. So here's what a call option looks like. You have some exercise risk, the value of the company, what you're going to get paid for. In this case, you have this premium that you're going to have to pay that actually equals the negative net present value. And you're hoping that over time, since this is a tech company, that it's going to go like that, right? At some point in time. And you bought it here, and it's valued up here, and the difference is basically your profit. The amount of money that you make. Okay? So the question then becomes, what is the value of the real call option need to be for you to accept this project? What does the value of the real call option need to be? What does it got to be? What's the value got to be? Well, why aren't you making the decision right now? Why can't you accept this project? What's the problem? What do we have? We have a negative net present value of $250,000. So what is the value of the real call option got to be? Yeah, it's got to be by how much?
By the net present value.
Got it. So it's got to be at least 250 million. And if the value of the call option is greater than 250 million, negative 250 million, what's the net present value? So if the value of the real call option is 250 million, and you get a negative net present value of 250 million, what does the value of the real call option need to be to accept this project? 250 million, got it. And if it's 250 million, what's the net present value?
0.
0. Would you accept or reject it?
Accept.
Got it. And if the value of the real call option is greater than 250 million,
Even better.
yeah, your net present value is going to be what?
Positive.
Positive. And do you accept or reject?
Accept.
Got it. And if the value of the real call option is less than the 250 million negative net present value, what's your net present value?
It's going to remain at a negative value, therefore you reject.
It's going to be negative and you're going to,
Reject.
got it. So that's it. Yes,
Is there 3 or 4 that,
There's,
value of real call option?
there's 4, oh, say that again?
Management decisions, volatility and value. of
Management
companies.
decisions, volatility in the value, and then time. And these, right here, this is time right here. And these call options usually last 3 years, but if I'm buying a piece, if I'm buying Mission Bay in San Francisco, that's like, it took 40 years to do that deal. Salesforce Tower, that was like 10 years. That was 10 years in the making. Other projects in San Francisco, especially real estate, they take between 5 and 10 years to do the big stuff. Tech companies, it takes some time. These investors are looking at the value of these real call options to justify the acquisition prices. They're willing to pay a lot more because they know that the valuations could go through the roof in the future if the company goes to scale. All of a sudden they move into the early majority, adoption cycle, or they just go vertical, on the demand for their products. Because tech companies, you just got a bunch of programmers and data scientists and a bunch of cloud computing storage. You're not buying equipment or manufacturing, and you're using social media to market your products. So you can scale very quickly, very rapidly. And that's where the multiples come in. That's why the multiples are so high.
Will we use the comments to justify our reasoning and or motivation to continue through several iterations before eventually accepting or rejecting?
Yeah, I can stop right here, right, if I get acceptance,
Hmm.
right? It's basically a decision rule, it's a decision tree. You know, if we get to rejection, but we still want the project, we can go to iteration 2. We ask for a price reduction. If we can't get the price reduction, then we go to iteration 3. Iteration 3, we go back and review all the assumptions. If we go back and we review all the assumptions and we still get a negative net present value, we can go to iteration 4. We calculate the real call option. If the real call option is equal to or greater than the negative net present value, we'll do it. If the value of the real call option is less than the negative net present value, then we reject it. That's it. I have no other options. Maybe you guys will figure out if there's an iteration 4. I don't know. I mean 5. I don't know. There maybe is, but this is
No,
as far as I'm gonna go.
What I was asking is, do we just use comments to justify our reasoning?
Just use what?
Comments to justify our reasoning?
Yeah, that's what you would usually do.
Okay.
Yeah, so for each one of these, there may be comments. So in your Excel spreadsheet or in your report, you would have a comment section that would give a little bit more detail. We couldn't get the price reduction, so therefore we went to review the iterations. After we reviewed the iterations, we couldn't find any additional information, so we felt that we had to calculate the real call option. We calculated the real call option. We still couldn't get a positive net present value, so therefore we're going to reject it. Or it's going to be positive. This calculation right here is theoretical, okay? Although it is used in tech and biotech, it's not used that much in real estate because they're about 20, 30 years behind in their ideologies and their methodologies. But the value of these real call options are usually done by individuals in the firm based on 30 years or 40 years of gut feel. But they could calculate if they wanted to. And some companies do, like Genentech and stuff, use real call option valuations to make investment decisions. Because they're looking at what? Drug trials, drugs, which aren't going to pay off for at least another maybe 5, 10, 15 years. So they got to be really thinking about, is their value not being reflected in the traditional finance, capital budgeting, that needs to be captured somewhere and it's captured. All right, that's it. Thank you.